Hi everyone, let's go over my micro bullish and bearish Elliott Wave scenarios on Bitcoin. Starting with an alternative bullish scenario where we're looking for a continuation to the upside after we had a three-wave corrective structure. Now this scenario is the same scenario as the contracting diagonal scenario I've shown you in the previous video, where we were then looking for a wave 1, 2, 3, 4 and eventually a wave 5 to the upside. However, there's something very important about a leading contracting diagonal, and that is overlap between a wave 1 and the wave 4. In many books and on many pages, when you learn about Elliott waves, you will read that if you look at contracting diagonals, you have to have overlap between a wave 1 and a wave 4. Now, there's sometimes a little bit of discussion. However, it is by far most common. Then you see this red little triangle over here, and this is the area that price can still move to the downside, bounce without touching the lower trend line for a leading diagonal. And you can see it is very small. Now how you do this is you pull a channel from the high of 1 to the high of 3 to the low of wave 2, because the lower trend line of the channel is an invalidation for a contracting diagonal. Because a contracting diagonal, well, the lower trend line has to move to the upside, right? Because you want to have converging trend lines in a diagonal. So therefore the lower trend line of a channel is the invalidation. Secondly, what you want to do is pull a horizontal on the high of wave 1, which I called wave 1 high over here. And then you get this little area. And this is the target area for price to move to the downside, not hit the lower trend line, move to the upside, and then it is a, well, in most cases, a valid contracting diagonal. And you can see that this space is incredibly small for price to bounce off. So that's why this scenario is currently an alternative scenario, where in a diagonal you would then be looking for upside. Now this area over here, as you can see, is also below the 0.5 Fibonacci pulled from the low of 2 to the high of 3, which is a common target for a wave 4 in a leading diagonal. But the golden pocket over here in orange is a rare target, and also this wave 2 bounced off a rare target for a wave 2 in a leading diagonal. So this scenario at the moment doesn't look that great. We have the same problem with a potential 1-2, 1-2 scenario, because if this is a wave 1, 2 and you are looking for another 1, 2, then usually a 1-2, 1-2 is something like this: 1, 2, 1, 2, and then another potential 1, 2, which again forms a leading diagonal. Very often a nested 1, 2, like a triple 1, 2 or a double 1, 2, is confused for a leading diagonal. But the same problem applies, that if you want to have a 1-2, 1-2, it's by far most common for the second wave 2 to have overlap with wave 1. But that's only possible if price is going to bounce in this particular area, right? So it still has to move to the downside and then move up. Secondly, if we look at the second wave 1 and wave 2, it's a lower degree as the blue count, because this is the higher degree 1, 2, 3, 4, 5, and then inside the blue 3 you have the white count 1, 2, 3, 4, 5, meaning the white count is of a lower degree than the blue count. But this wave 1 is longer in time than this wave 1, and therefore this scenario also again becomes like an alternative, because the wave 1 and the wave 2 of a lower degree count, by far most common, are shorter in time than the wave 1 and the wave 2 of a higher degree count. So this one also does not look that great. Then we have this scenario, which is basically the scenario that has to save it all for the bulls, which is then a wave 1, 2, 3, 4, 5. However, there's always that however, right, in the bullish scenario at the moment. In this scenario, wave 3 is incredibly short. Wave 3, which usually in an impulsive structure is the biggest, most impulsive, highest volume move to the upside, this wave 3 is shorter than this wave 1, which therefore means that wave 1 could be the extended wave, as a wave 5 is now not allowed to be longer than wave 3, because wave 3 in every impulse has to be the longest way, or not the shortest wave, so it has to be longer than either wave 1 or wave 5. This means that this wave 5 has to be shorter than wave 3, because wave 1 is longer than wave 3, meaning that the maximum target for wave 5 is the 1-to-1 over here, which is pulled from the low of 2 to the high of 3 to the current low that we have of potentially this wave 4, sitting at 32.1k. So if price is going to reach this area, then this scenario is also invalidated. Now, if price would move towards the upside impulsively, then a potential 1-2-1-2 scenario gains more weight and gets higher probabilities. But of course, we first have to get here, right? Now, in this scenario, what you can see is the invalidation is very close, because the invalidation of this scenario being a 1, 2, 3, 4, and then up for 5 is overlap with wave 1. So in the other scenarios, bullish scenarios, you want to see overlap between 1 and 4, but in this scenario, you want to avoid overlap between wave 1 and the potential wave 4. You want to see continuation to the upside, and surely you want to see the high of this wave 3 being taken for then this wave 5. Now, if I pull, like if we think this wave 1 is then the extended wave, right? Extended wave 1, then we have a 2, 3, 4, and 5. Then if wave 1 is extended, which doesn't happen very often to be honest, then you can pull a trend-based fib from the low of 1 to the high of 1 to then the low of this wave 2. And then the target for a wave 5 most commonly is over here. Let me actually find it. Wave 1 is in between these Fibonacci's, but as you can see, the high of wave 3 already went above the most common target area for a wave 5 if a wave 1 is extended. So also this is not looking too great for the bulls. If we then go to the bearish scenarios, then over here what you're looking at is a WXY. So we have a 3-wave in a W, a 3-wave in an X, and then we'd be looking for a 3-wave structure to the downside in a wave Y. The most common target area for wave Y is between the 1 and the 1.236, taken from the high to the low of W to the high of the X that we have over here, which is currently sitting between 29.3k and 28.9k, which is in nice confluence with the target box that we have over here that I've been talking about for a while now, of course, over here between 28.8k and 29k, with some interesting support for then potentially that bounce for then continuation to the upside. Now in this particular scenario, you see a couple of fibs on the chart. The green fibs over here are fibs taken from the low of W to the high of a potential wave A to the low of then a wave B, because we're looking at a 3-wave structure, because X has to be a 3-wave move. So we're then looking at an ABC, where this is an impulsive wave A, sideways wave B, and then a 1, 2, 3, 4, 5-wave move to finish wave X around the 886. However, what is striking is that the most common target area for a zigzag, because this is then a 5, 3, 5 move, an ABC zigzag, most common target for a zigzag is between the 1 and the 1.236, which has not been reached, as you can see. Price just came short of hitting that 1-to-1, also on the linear chart. So that is a bit of a pity. A rare target for a wave C is the 0.618, which of course has been passed. As you can see, we got close to the 1-to-1, so this is still a valid scenario. It's just a pity we didn't reach it. Now in this scenario, what you also see is the 1.618. If price is going to pump through this area and move towards the 1.618, it is much, the probabilities go up for the bullish scenarios. We also have the 2022 range highs over here. Then lastly, you see the 886 on the chart, which is pulled from the high to the low of W. This is a valid target for the high of a wave X. Now usually, and I mentioned that in the previous video, if the 886 is hit, you prefer to see an immediate rejection to the downside. The longer you range around the 886, the higher the probabilities of taking this high. However, the high for a wave X can be the 886, as it is a common target still for a wave X. If we go to another scenario, which is very, very interesting, we then have a wave A, B, C regular flat. And the target for a regular flat has been hit because it's between the 0.9 and the 105 taken from the high to the low of a wave A. And a regular flat is a 3, 3 and then a 5-wave move to the downside, while a wave Y is a 3-wave move. So now in this being an ABC regular flat, you want to see an impulsive structure to the downside. Now the support that it has to get through is between 30.5k and 30.7k, and if price is going to drop through this area, then the probabilities are very much increased to go to the downside and look for around that 29k area. This is a very interesting area or a scenario indeed, with then the invalidation basically being the 105, which is sitting at 31.5k, but preferably the high of then B is already in and the invalidation is at 31.4k. If we look at the CVD, it was a busy day, talking about CVD a lot in the short-term updates in Discord as well as on Telegram, where a lot has been going on. So first of all, price moved towards the upside and was very close to creating bearish CVD divergences over here. Then price moved to the downside, creating bullish CVD divergences. So we had a bit of a bounce over here, bullish CVD, bounce up, but then bearish CVD divergences. Price moving down, bullish divergences are still there. But then again, with this little candle, bearish CVD divergences. So twice bearish CVD divergences for eventually a move to the upside where the bullish CVD did play out. So both of the bearish CVD divergences played out and this bullish CVD divergence also played out. So that is very nice. For now, this crazy price action, by the way, during this recording to the downside with a massive wick here. That's very interesting. So now the CVD divergences are neutralized. We can actually go to AGGR over here, where if I quickly refresh, this is the 15-minute. Let's actually jump to the 5-minute over here, where you can actually see it. So we had a higher low in price, but both on the yellow line and the blue line, we started to create bullish CVD divergences. With the yellow line over here, you can see this, the yellow line over here is below the line here on the left. So bullish CVD divergences. Also on blue, lower CVD divergences, higher low on price, lower low on the CVD, that's bullish. However, during the bounces we had over here, lower high on price, higher high on the yellow CVD, that's bearish, and then here once again. So yeah, this is all neutralized now, and we have to wait and see, of course, what price is gonna do. If we then finally talk about the probabilities, then I wrote down the following. So probabilities, right? On the top spot at the moment, and that's because of those bullish scenarios, top is then the micro bearish scenarios, maybe even the flat scenario of a 3-3-5 wave move to the downside. The thing is that with all of the bullish scenarios, like this one, you know, price has to get into this triangle, very low probability, you know, that it's not going to be invalidated. It's very likely to be invalidated if it goes down. So this one is not preferred. This one, same problem, not preferred as well. It's not a must for wave 2 to have overlap with wave 1. It's just by far most common. Then this is the savior for the bulls over here, but then this wave 3 is very short, wave 1 is extended, but the wave 5 target has already been reached, so that is not very nice. And then you basically get stuck with the bearish scenarios, where in this scenario possibly an ABC flat, which is this one over here, could be the preferred scenario for then a move towards the downside. Yeah, so that is it basically. I hope this video was helpful or valuable to you. Please check out the most recent educational video I have made about the best trading indicator you can use. And for now, thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.